This sixth stock I'm screening operates fine dining and casual dining restaurants. Restaurant names I've never even heard before. Eddie V's, Capital Grill, Olive Garden Restaurant, Longhorn, Bahama Breeze, Seasons 52, Red Lobsters, Cheddar, Scratch Kitchen. I don't even know how to pronounce them. They serve in the US, Latin countries, and the Africas. I don't know much about this stock, to be honest, but I'd be reviewing their financials and give my honest price targets for the stock. The stock is DRI, Darden Restaurants Inc. To be completely honest, fine dining, casual dining aren't exactly my thing. I rarely do fine dining, mostly casual, and it only happens like once in a blue moon. Once a month, maybe once in 2 months. Very rare. These aren't the type of stocks I'd personally relate to, so if I'm ever buying this stock, I'd buy this cheap. Anyway, let's look at what prices we should buy DRI. I think you know my process by now, so I'm just gonna breeze through my process. DRI is currently trading at $126.38 with high price of $164.28. That's 23% of the highs. Market cap of 15.76 billion and PE ratio of 15.92. They give out an annual dividend of $4.4 per share, a yield of 3.48% of the current price. First metric, EPS multiple is lower than 3, good. EPS is increasing, good. OSN, not much movement for 5 years. Not good, not bad. Sure. Second metric, low margins, trading at 2.61 times margins. Margin of safety I used here, 30% normal. I'm looking at PEs of 6, 8, and 10. Price to free cash flow is 15.73. Discount of 1.01. I like this. I might be buying this. Payout ratio is 55.21. I think the dividends are safe with DRI. Future prospects for share repurchase and dividends hike is very low. Only 4.6% of the dividends remaining to them. It's very low. It's not very encouraging, but sure. Historical data suggests it's trading at a discount now, 0.82 times. PB ratio, a bit high, 6.89. I want this below 5. Current ratio, not good, at 0.7. We want this above 1. Debt levels are alarming for the stock. I don't like this. Look at this. 12, 21. I think they should cut back the dividends. This is bad. So, you might want to check your tolerance with long-term debts. I'm kind of torn. I want to say it's overvalued based on my second metric, but the third metric suggests that it's trading at a discount. I'd rate it fair. I'm going with my third metric, 1.01 times multiple for price to free cash flow to PE ratio. I don't own the stock. I don't think paying premium is necessary, although the company is growing their revenues. I have fair value of $48, intrinsic value of $64. This is from Guru Focus. Here are my entry prices and PEs, 6, 8, 10. I could be a buyer of DRI at $80 and below. Let's confirm these prices with their charts. I'm guessing at 110, the price to free cash flow to PE ratio should be below 1 by this level. So you might want to start a position below 110. That's for a trade. Also, $110 is also 4% dividend yield. $88 is 5% dividend yield. My high entry price is $80. I don't think we'd reach those COVID lows again. So yeah, I think $110. Start a position there, maybe for a trade. Then $88 for 5% yield. Again, You're buying the stock based on the price to free cash flow, not their margins necessarily. Personally, I wouldn't buy this for long term, but it's good for a trade though, maybe a swing trade.